starting today's session with Daniel Keiper-Knorr, founder and general partner of SpeedInvest. Daniel, welcome to the show.
Well, pleasure to be here, Romana. Thanks for the invitation. Good morning to everyone.
Good morning. So Daniel, let's start by getting you acquainted with our community. Tell us about you, your investment focus, about the firm, how big is the fund, what size checks do you like to write? Just get to know each other.
Mm-hmm. Sure. Thank you. So SpeedInvest is a venture fund out of Vienna, focusing on pre-seed, seed, early stage into Series A. We are doing digital only, so we're digital pure play, but within digital we are more or less agnostic. When it comes to investment topics, our typical tickets, entry tickets, are around 500K. In the first round, we can invest a total of up to 3 to 5 million per startup over several rounds. However, entry tickets range from as little as 100K to up to almost $1 million. We look into practically, as said, everything, but doing this since 2011 now. We are in our third fund generation that we invest from. In total, we manage 230 million euros assets under management. We are just raising a new fund this year. Again, staying with the same strategy. Pre-seed, seed, and early stage, digital pure play, pan-European. So our current portfolio across the 4 funds that we currently manage is more than 120 investments across 23 countries, ranging, say, from Portugal up to the Baltics, from the UK down to Israel and Turkey. Selectively, we go beyond Europe. So we have we have 2 direct investments in the US. We have 1 in Brazil, 1 in Russia, 1 in Ukraine, which we actually consider Europe. However, the lion's share of the portfolio origins from German-speaking Europe, which is a natural thing given us starting the firm back here in Vienna. But German-speaking portfolio is just about half of the portfolio, and the share is decreasing to the benefit of non-German-speaking Europe countries.
So you do both B2B and B2C, Daniel?
We do. However, our own entrepreneurial DNA is from B2B business. So the core team that founded SpeedInvest back in 2011. It's been a team of 6, including myself. We ran a mobile messaging business, which in 2006 we sold to Verisign. And so our own entrepreneurial DNA is digital B2B enterprise, but still we look into consumer and e-commerce and B2C. However, it's very selective. We can probably dip into some cases, which I'm happy to elaborate a bit later on. But the bigger part of our portfolio is in B2B, but don't be shy showing us a good B2C cases. We just recently tapped into the e-scooter business in Europe. We are invested in the world market leader in spirit e-commerce. So typically we go for either momentum cases like the scooter business, or so non-obvious things that have been overlooked by the VC herd, where you can get in early at reasonable terms, work with the entrepreneur for the first 1 to 2.5 years, a bit under the radar, to really get the company in shape, and then break it out in a meaningful Series A that they will raise in the range of 3 to 10 million, typically from European follow-on VC funds, such as Atomico, Index, and others.
So let's actually double-click down on your portfolio, and what I would like to do in the next segment is have you take us through when these companies came to you, in what shape did they come to you, what stage, and what is it about them that attracted you enough for you to make the investment? So what I'm trying to do here is to familiarize our community with your thought process.
Okay, I'm glad to. So typically we try to be, say, the first institutional investor coming on the cap table. However, we don't see ourselves as a typical institutional because we run a very specific model which differs significantly from the standard 220 VC model. Say a partner managing 50 million, supported by 2 to 3 principals and double the number of analysts and associates. Our model is different. As said, we manage 230 million currently. We're doing this with a team of 50 people spread in offices in chronological order of their opening: Vienna, San Francisco, Munich, Berlin, London. So we run a San Francisco office ever since, from day one. Back in 2011, we already had the third of a team full-time based on partner level in San Francisco. That team over there typically helps us in screening and benchmarking deal flow. So when we identify a company over here in Europe, we quickly show it to our US partners and see if this idea gets them going in a way or is not exciting to them. And once the company is on the portfolio, the US office helps a lot with fleshing out the US go-to-market strategy. Also, and in a later stage, when they're approaching the later funding rounds, they do a great job when it comes to presenting those companies and pre-qualifying potential follow-on investors and make sure the entrepreneur has only to do those meetings that are worthwhile attending, and we try to spare him from all those empty kilometers that typically are there when you go out on a fundraise campaign. So at what stage are the companies approaching it? As I said, we are trying to deploy a first ticket of 500K. This implies, of course, a valuation in the range of, say, 2 to 5 million euros, which per definition is seed. So a company in seed is definitely pre-product market fit. This is at least our understanding from the European perspective. We like to see companies pre-product market fit. However, they should have at least a prototype working, or first POCs, not necessarily commercial POCs, but at least productive POCs, where industry corporates are taking on the software, running it at least in an internal test environment, speaking for the B2B space. And we regard the role for ourselves as helping the company move it quickly towards product market fit, because we try to get in between minimum viable product alive and product market fit not totally reached yet. Some signs there, but can be false positive. So our job is, together with the entrepreneur, take his product, bring it together to the market, work on the positioning, and maybe run through a pivot together with him or her. And all we do is pointing to the target of getting the company Series A ready. This means shaping out the product, testing the market, winning some first customers together. Maybe if it's in SaaS business, bring them over into the renewal phase of the contract with as little churn as possible. Take together the entrepreneur enough, take the learnings out of the market, refine the product, stock up the team. Typically, entrepreneurs pitch to us in the first moment, where in a good deal of cases, the team is not complete. However, of course, the core team, the driving force, the entrepreneur is there, but clearly the SVP level is not. Maybe even there are some blanks in the C-level founder team as well, which we then running our own HR unit, helping our portfolio to recruit, trying to fill those blanks. getting the team complete, the product in shape, the market tested, and then with those signals from the market with reducing sales cycles, increasing order volumes, and all those things that tell us that the company is about to approach product market fit. And in terms of a SaaS business, this is the famous 100K MRR number. That should be clearly in sight. However, we start fundraise for our portfolio companies the A round when they get past 60 to 80K MRR with a clear path to crack the 100 within the next 1 or 2 latest 2 quarters. Just for one example, we had one company in the portfolio in the edtech space, also an area that is not so much in fashion with the VC industry very recently, but still you can find super talented teams. The market is still large and growing. And as in the recent, say, 3 to 5 years, it probably was all about analytics. Nowadays, and in the coming 2 years, it's going to be all about data quality. Because all that AI and ML stuff will never work if the data quality is not there. It's not just about quantity. Quality is just as important. So, for example, take the whole mobile installment download business for apps and games and entertainment, also utility apps you have. All those fake downloads there, they're all coming in the top end of the funnel of all those analytics programs, and they then process the dirty data. This is completely worthless. You make sure that the data is clean, and with clean data, you can extract insights that are truly useful to really grow a business.
What percentage of your portfolio, Daniel? What percentage of your portfolio is B2B SaaS?
Probably a third to a half, at least. Yeah.
And the rest, what percentage of the rest is B2B still?
Well, there are other increasing. So we just recently detected the investment topic of industrial tech. So like startup with software for industrial appliances, which is not necessarily SaaS because these are large enterprise contracts where you do one contract that pays you 500 to 1 million ARR, and you do 2 of those contracts a year. This is not the classical SaaS model. That's not even if you take that.
But if it's a subscription fee,
analogy from
considered SaaS. At least in Silicon Valley, it is. There are a lot of enterprise SaaS companies in Silicon Valley.
Of course, it is. If you put it all together, the compartment B2B and SaaS, that's typically I would say 2/3 of the portfolio.
Okay.
So
now,
this is clearly the.
Yeah. So can you comment on what are the trends in Europe in that domain, in whether it's B2B, SaaS, enterprise software, subscription-based enterprise software? What are the trends, and what is, if you were to highlight what is Europe's unfair advantage today in that domain, what would you say that is?
I would say that clearly in that space, which is dubbed AI and ML. Big data, AI, ML, that's all kind of these are all related terms. Of course, they all have their individual face, but I think this is a space where Europe can have an edge globally. Of course, the competition is awake, and especially when you look to the Far East, China, Japan, and Korea, especially China, they will have their stake. But where Europe can really differ is when it comes to startups that cater to what makes the European economy work. And the typical European economies are run by manufacturing and financial services. There's not that many large consumer brands. Of course, there is a single, but consumer, I would say, in the US is a much more important thing, also due to the fact that it's such a large common market, one language, one currency, more or less a similar mindset, whereas in Europe you have to deal with kind of 15 languages, several currencies, taxation, and this, of course, to B2B and SaaS, this makes not such a big difference, but in consumer, it does make a difference. You have to address every single country's consumer base with its own narrative language. It comes down to such simple things as like when you, like here, live in Austria and you call customer service of whatever product, can be a software startup or for day-to-day use, and there's someone picking up the line not speaking your dialect, that feels strange. It still does. Even if it's a German-speaking, native-speaking person that comes from the other end of the German-speaking area, it feels totally weird. And this is simply a fact that one trying to do consumer in Europe has to bear in mind. It's totally not an issue when it comes to enterprise. And this paired with the fact that it is our strong belief that the European entrepreneurs, engineers, not the entrepreneurs, the engineers, are heads up with the good engineers all over the world. We experienced this ourselves when we sold our company back then. So like we strongly believe in European engineering talent. What it lacks in direct comparison to especially the US is probably that market-centric thinking. And this is kind of what we see as our task in working together with the tech entrepreneur, in educating them on how to bring product to the market and apply design thinking out of the perspective of the user and consumer.
Yeah. So I'm going to switch a little bit the line of questioning. There's one topic that I want to explore with you, which is very much in line with what you're saying about the European market, and it's in a relative fragmentation due to language and culture and the country, country boundaries and so forth. In Silicon Valley or in the US market, in the Chinese market, and even in India right now, there is this kind of traditional venture capital. Every deal has to be $1 billion TAM. Every investment has to go from 0 to $100 million in 5 to 7 years.
Yes.
This kind of thinking, the unicorn thinking, is prevalent. But given the fragmentation that you're describing in Europe, I imagine there are lots of opportunities for smaller TAM, more niche deals where you can invest and you can still make very good revenues, very good, build very good businesses, except that there are certain dynamics that are a bit different, right? They have to be built more capital efficiently. You can, let's say, build for $1 million, $2 million, $5 million, and sell for somewhere between, 15 to 30 million, or build for 5 to 10 million, sell for 50, 60 million. Are these acceptable deals for you and for some of your compatriots?
I'd say yes. Looking back to our own history, our first fund back in 2011, that was a 10 million small boutique. Yeah. So running such a small fund, you of course typically do those deals, and still we stuck with our plan to have entry tickets of 500K, and if that grows tenfold, there's no further dilution, probably one additional round where you keep your pro rata and put in another $500,000, and then that such a company sells for in the bracket of 25 to 50 million, that can still be a good deal. However, of course, with a growing fund volume, to return the reward to your LPs is of course getting a bit difficult. So you must have a very high quota of successful exits in that valuation bracket to make the whole fund model work. But still, especially for SpeedInvest, this is actually a line of thinking that we work along. Also, given the fact that I would say like 80% of all exits happen below 50 million enterprise value.
Exactly.
And if you read the news, you only get those big, the billion-dollar stories. And the other space is totally overlooked. If we can help the entrepreneur, we run a small M&A team in our fund that also works alongside the investment managers team, just monitoring the portfolio and seeing who is probably developing in a way where it's probably organic growth, cash flow positive, doing kind of 10, 20 million revenue a year, and then very targeted look for potential exit partners. However, if you do such exits, it's very helpful if they come very early in time. So holding such a company for like 8 to 10 years and then doing a 20 to 50 million exit is still better than a write-off for all parties involved. And still we see this as our own responsibility towards the entrepreneur because he opens up to us, he takes us as a shareholder into his company, he has the right to expect contribution. This is our day-to-day business, raising funds and structuring M&A. To the entrepreneur, this is a once-in-an-entrepreneurial lifetime experience. To us is, I don't know, I have like 10 companies concurrently that I fundraise for at the moment. So absolutely, we go after these deals. However, it would help a lot if these are going to not be financial exits to PE companies. These are strategic buyers then coming in, and that space that is just opening up to acquiring startups at a larger scale in Europe. And that's it's an extremely good sign to see.
Okay. Are you based in Vienna?
Myself now, yes.
And is there entrepreneurial activity in Vienna, in the city?
Oh, absolutely. I mean, we are hosted here in a large co-working space where we are renting an office on a permanent basis. In the floor below us, they run acceleration programs with 3 batches a year. There's a lot of things going on. I said in our portfolio, historically still a third of the complete headcount is Austrian entrepreneurs. Of course, this is shrinking as the portfolio grows and we increasingly source from other parts of Europe. But there are good entrepreneurial stories coming out of Austria and, of course, also in the wider aspect of the region, say Central and Eastern Europe. Super cost efficient. An engineer over here costs a third than what he costs in the valley and can do the same.
I love Vienna.
$1 investment gets you 3 times the runway that he buys in the valley, and it's super cost and capital efficient. Public grant system is very attractive, and this makes up a bit for probably the corporate space not being so active yet, but we are working towards that this will change. So we're totally happy here. We could not imagine having built SpeedInvest anywhere else.
Very good, excellent, wonderful conversation. We have a lot of stuff going on in Europe. I don't know if you saw, we announced last quarter, I think, a partnership with EIT Health, the European Institute of Innovation and Technology, and their digital health program. And at this point, it's our program and their program is getting very deeply integrated. So, and we have a lot of European companies in our portfolio.
That is totally exciting. So digital health, e-health, whatever you name it, is one of the emerging topics that we increasingly look at. We have probably a tenth of our portfolio is already in e-health.
Great. Very good. All right. So that is an excellent introduction, Daniel. We look forward to doing some more work with you now that we have had a chance to touch base and get acquainted